You sit down at the table, pen in hand, and sign the final document. The agent smiles and hands over a heavy brass key. You have just closed on an oversized home. It feels like the definitive marker of success, a rational, smart adult decision. But as the agent shakes your hand, a quiet transfer of wealth is taking place. Before you have even moved a single box, thousands of dollars have been redirected away from your net worth. This follows the same logic as the classic car dealership trap. When you drive a brand new vehicle off the lot, 15 to 20% of the value evaporates the moment the tires touch public asphalt. Real estate features a mirrored process called friction costs. Standard agent commissions, origination fees, appraisal costs, and title insurance create an immediate wealth reduction event that mirrors vehicle depreciation. These transaction fees erase a significant portion of your capital before you even unpack. It is money that no longer works for you. Buying the largest house the bank will allow is often framed as an investment. In practice, the high friction costs of the transaction move wealth away from the buyer and toward the industry facilitating the sale. When budgeting for a home, most people focus on the monthly principal and interest. However, the mortgage payment is only the baseline. This chart breaks down the true monthly requirements. First, we add property taxes. When you buy a high-status property, the county reassesses the value, which increases your monthly cash obligation. Next are the mandatory HOA fees. Prestigious neighborhoods often require monthly payments to maintain an aesthetic of exclusivity. This is a recurring expense that does not build equity. Finally, the maintenance rule applies. Keeping a large structure functional costs roughly 1 to 2% of the property value every year. When broken down monthly, these repairs can exceed the original mortgage payment. These combined layers represent the true monthly cost of homeownership, a figure that is significantly higher than the initial bank quote. Every dollar spent on these unrecoverable costs is liquid cash that is no longer available for actual wealth building. Consider an alternative scenario. If you choose a functional, modest home instead of a property with excessive square footage, you could free up $1,000 in liquid cash every month. If you took that $1,000 and invested it into a simple S&P 500 index fund at a 10% historical average return, the math changes your financial trajectory. After 10 years, that redirected cash grows to over $200,000. By year 20, the balance exceeds $750,000. After 30 years, the length of a standard mortgage, the account holds $2.2 million. This $2.2 million is the invisible opportunity cost of choosing a status address over a functional one. Why do buyers willingly trade millions of dollars in future wealth for a specific set of walls? Real estate culture encourages us to prioritize trendy aesthetics and zip codes over utility. We have been conditioned to view shelter as a lifestyle brand. This is a direct extension of car culture. Buyers often stretch their budgets to pay an ego premium, securing a logo on a steering wheel or an address that signals success to neighbors. When housing debt is driven by status rather than the need for shelter, the financial consequences are measured in millions of dollars of lost retirement wealth. Data on self-made American millionaires shows a pattern that contradicts the status-chasing buyer. True wealth is often built in unglamorous neighborhoods. These individuals prioritize modest, functional homes that keep their fixed monthly costs low. This matches the Toyota principle. High net worth individuals often choose assets based on utility and reliability, preserving capital that would otherwise be lost to status signaling. To escape the trap, start with 2 steps. Buy strictly for utility and calculate all unrecoverable phantom costs before signing a closing document. Third, run the opportunity cost math. Calculate the difference between the house you need and the house you want, and look at what that money would become if invested for 30 years. Finally, you must separate your identity from your mailing address. Internalizing the fact that a home is a machine for living allows you to make financially rational decisions. You can choose to maintain the illusion of wealth by paying for an ego-driven zip code, or you can detach your identity from your address and capture your $2.2 million.